Hello, this is Brian Rezny, president of Rezny Wealth Management, bringing you the Rezny Wealth Report. We've got a great show for you today. And as always, send us your email questions to brianrezny@reznywealth.com. And make sure you visit our website, reznywealth.com. For great information, sign up for instant email alerts about investment topics that I discuss often. Download any of our groundbreaking reports for free, like why annuities are dangerous to your wealth and retirement, or fee-only fiduciary money manager versus an advisor, a salesperson, how to protect your wealth from bad advice, and a whole bunch more. Again, go to reznywealth.com. Today's show, I want to talk about, what real money management is, and I want to talk about what a real money manager is and versus an advisor, or which is really a salesperson. I've been managing money well over 30 years. Unfortunately, thousands and thousands of calls and emails that I've received throughout the years on my TV and my radio shows come from investors who are really taken advantage of. And people often ask me, in my estimation, 90% of advisors really are salespeople that work for Wall Street type firms, brokerage firms, banks, and insurance companies, and they don't actually manage your money. An advisor really is a salesperson that sells products they're required to sell through that institution that they manufacture, sponsor, and basically put on the shelf. These are inferior, lousy investments. But I get these comments all the time on my TV and radio shows. People that hire Rezny Wealth Management every month come from these firms. 90% of you investors are working with one of these firms. And it could be your brother Bob, your sister-in-law Sue. They're not the problem. It's the institution they work for. So again, investors put up with mediocre advice too long, and it costs you. You as the investor have to realize the longer you wait to get quality investment management, and I'm talking real money management, not a sales job, from the big bank, not a sales job from the free steak dinner seminar where the guy's trying to sell you an annuity, not a sales job from the big Wall Street or brokerage firm that basically has to sell the products they're required to sell so that advisor makes his sales quota and gets his pay grade. Don't settle for mediocre advice. It's going to cost you a fortune. In our estimation, investors, by the time they're 65 alone, from just receiving bad advice, having bad investments and mediocre investments in their portfolio for decades, have 2/3 less investment net worth than they should. Now imagine you're 65 and you continue with the same mediocre advice. Your retirement security is hampered. So again, do something about it. Let's talk about conflicts and being sold inferior investments that rob your returns and your retirement. Again, as I talked earlier, banks, brokerage firms, Wall Street type firms, insurance companies manufacture investments. They sell you the unsuspecting investor. Those investments are often inferior and expense-ridden. And so why is it, even if, again, it's your brother Bob who's your advisor at that big firm, why does he show you one investment over the other? It's not because it's the best. It's because he's required to sell that investment through that firm that they either manufacture or sponsor. How does that investment get on the shelf at that big brokerage firm? Easy. That investment company pays a big fee, a shelf space fee, to that brokerage house or bank or insurance company to get on the shelf. That comes against what you're looking for, which is objective, real money management. So again, make sure you do the right thing. Procrastination is costly to your wealth and your financial security. Everybody procrastinates. I will tell you this, the vast majority of people that call my firm for a consultation because they're looking for real money management and real advice often have listened to my TV or radio shows for years. They've been through 3 or 4 or 5 different Wall Street type firms, banks, or advisors, which they finally realize are salespeople. But they procrastinated. Why? They settled. Don't procrastinate. It doesn't get better on its own. If you have any doubts how your money's being managed or really not managed, or you're realizing your returns have been really mediocre or downright lousy, or you've been sold the crummy investments that I often warn investors about, it's time to pick up the phone and call Rezny Wealth Management. Hire a real money management firm, which would be a fee-only fiduciary money manager. The only kind of real money manager is a fee-only fiduciary money management firm like a Rezny Wealth Management. We estimate that about 10% of firms nationally are fee-only fiduciary money managers. The rest of these advisors, which are just using a fancy title of advisor, are really salespeople. Again, working for Wall Street kind of firms, brokerage firms, banks, and insurance companies. They're not advisors at all, and they're certainly not money managers, and they're not managing your wealth. They're selling you and offloading investments they are required to sell through the firm or institution they work for. And that is sad, and that is very costly to your financial security, of course, and your wealth. Never settle. Never put up with conflicts from a so-called advisor. And again, if you're having any doubts about the way your wealth is being managed, you've got subpar returns, the communication is poor, your advisor doesn't really answer the questions you ask, you're realizing finally that it's time for a change. Again, seek professional help. You can call Rezny Wealth Management. We, again, are a fee-only fiduciary money management firm, providing exactly what our clients need. Timely money management, real advice, and real money management 100% of the time. And by the way, when you're dealing with a fee-only fiduciary money manager, we are legally obligated as a fiduciary to work in your best interest 100% of the time. An advisor cannot say that because they're, again, a salesperson, not a fee-only fiduciary money manager. By the way, if you want to learn more, I have an upcoming webinar. The disturbing facts most investors are shocked to learn. How investors, you, get ripped off by Wall Street type firms, banks, and these annuity salespeople every day. I'm going to teach you how to protect your wealth from bad advice. If you want a game changer, go to ReznyWealth.com. Click on our webinar tab. Sign up for our webinar. It will change the way you look at investing, and it will change the way you invest your money going forward. Again, don't settle. If you want to avoid the conflicts, the bad advice, and the disasters that so many investors face every day, sign up for our upcoming webinar. Again, go to ReznyWealth.com. All the information's there, and to sign up. I want to go to my first question. Chris in Port Charlotte, Florida. Brian, I enjoy watching your report every Saturday, but was wondering why you never mentioned Bitcoin. Chris, excellent question. Bitcoin is basically a cryptocurrency. I actually do get a lot of calls about cryptocurrency and Bitcoin. I don't take every one of them because I get literally hundreds of questions throughout every single show. So ultimately what I would say to you is this. Bitcoin is a speculative investment. It's not an investment really at all. It's basically almost going to the craps table. It's like trying to win the lotto. It's not an investment. It doesn't belong in your portfolio. There will be a day that cryptocurrency will be a useful mechanism for transfer and payment, but as an investment and thinking you're going to get rich on this, do not do it. It's risky, and you've got a chance for major losses if you do buy anything like that. Maurice in Fort Myers, Florida. What do you think of tax-exempt bond ETFs? By the way, folks, an ETF is an exchange-traded fund. It's kind of like a mutual fund, but without the cost structure. Maurice, tax-exempt bonds may make some sense in a portfolio. A lot depends on what kind of tax-exempt bonds you're talking about. Remember, there's not one tax-exempt bond. There's many different flavors of tax-exempt bonds, whether it's maturity level, the duration when they mature, either the state or the city that may be utilizing these tax-exempt bonds. You want to really understand what kind of bond you're buying. Does it fit in your portfolio? Just because it's tax-exempt, meaning you're not paying tax on the earnings, doesn't mean it's necessarily good. What I will make a comment in general, what we are finding, the majority of investors who buy any kind of bond really don't understand what they're getting themselves into. They don't understand the risk of bonds, and I'm finding today, under these low interest rate environment that we're currently facing, that investors are overloaded in bonds, meaning you have too much or too big a percentage in your portfolio of bonds, and that is way too risky. Bonds in general, the next decade in our estimation, investors are going to be lucky if they make 1.5%, maybe 2% on the typical bond that you used to buy 10 years ago. Because remember, rates are low. But if rates move up, bond values can go down. Folks, I'm going to take a quick break. I'll be right back with more questions after this. Make sure you go to ReznyWealth.com. That's ReznyWealth.com. Check out our webinar tab. Sign up for our webinar that's coming up, The Disturbing Facts Most Investors Are Shocked to Learn, the true cause of poor investment returns and how to fix it. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. I've managed money professionally for over 30 years. The biggest mistake I see investors make, being sold an annuity. Annuities are sold on blatant lies, fake free money bonuses that never materialize for you, the consumer. Before your retirement gets ripped off by an annuity salesman, get my free report, Why Annuities Are Dangerous to Your Wealth and Retirement. And we're back. Hopefully you're enjoying today's program. We're taking your questions. You can send those to Brian Rezny at ReznyWealth.com. And make sure you do visit our website, ReznyWealth.com, for any great and late-breaking information that we have available on our website. We have free reports available to educate you, the investor. We've got some upcoming webinars, The Disturbing Facts Most Investors Are Shocked to Learn. You can sign up for that. This will be a game changer. If you want to learn a lot in a short period of time, go to our website. Our webinar, and again, sign up via our website, talks about the disasters that investors make too often. How to avoid those? So we're going to teach you what to do and, more importantly, what not to do with your money. William in Florida. Knowing mortgage rates are now at around 2.75% to 3%, and market investments say can make between 7 and 10%, does it make sense to apply for a mortgage of $225 and use that dead money in our investments? No. First off, it is against rules and regulations to tell an investor to mortgage their house to invest the money. Do not do it. So I don't know if somebody's telling you to do that, but I would never tell an investor to do that. That would be the biggest mistake in the world. You should invest your money that you already have properly, but never borrow against your house in order to basically make investments. That is a cardinal sin, and it is illegal for a firm to recommend you even do that. Again, if you've got questions about your overall portfolio, give us an email at brianrezny at ReznyWealth.com. We love taking your questions. We want to answer those on the TV show. Hey, and by the way, I've got a live radio show every Sunday morning from 10 to noon. If you go to ReznyWealth.com, click on our TV radio tab, it'll talk about our stations, time, and availability. We do have an upcoming webinar, by the way, The Disturbing Facts Most Investors Are Shocked to Learn, the true cause of poor investment returns and how to fix it. We're going to teach you what you should be doing with your money and what you should not be doing with your money. Managing money professionally for over 30 years has taught me one thing: learn from other people's mistakes so you can profit. Why make mistakes yourself? I'll teach you the mistakes others have made that have cost them dearly, not only in returns, but also risk in the portfolio and jeopardize their retirement. I'm going to teach you what not to do. So if you want a game changer on how you invest your money and how you look at investing, go to ReznyWealth.com and click on our webinar tab. Barbara, Naples, Florida. Brian, in as much as iShares, a small cap, has lost a lot of value since I purchased it, should I buy more at a lower price or ditch it at this time? Barbara, I'm not sure when exactly you bought the IJR, the iShares small cap. When you're buying any kind of equity type investment, and again, this is an ETF, it's well diversified. There's approximately 600 stocks in that particular ETF. They're smaller in size. What you're looking at is this. Don't worry about what happens in the next 1, 2, or 3 months. If you're buying something like small cap, you're buying that for the next 3 to 5 years realistically. The economy is stabilizing and going to start resuming growth. Small cap should do well overall. But what we look at as a firm is we look at what's called relative strength and addition. We look at assets, all asset categories, whether it's, let's say, pharmaceuticals or technology or large cap versus small cap. We look at something called relative strength. We like to own assets that are relatively stronger. What I will tell you is this. Generally speaking, large cap equities have been relatively stronger, especially large cap growth over large cap value and over small cap. over the longer term. And we usually look at periods between 6 and 12 months. Right now, I prefer large cap. It doesn't mean you should necessarily sell your small cap, but I will say this. I think there is more stability currently, and I think we're going to see more of that, and I think there's more opportunity in large cap growth than there is in the small cap marketplace. Susan in Sebring, Florida. I want to do some trade internationally, but I don't have much money, and I'm an investment newbie. Your thoughts? Susan, if you don't understand how to invest, get professional help. Do not hire an advisor. Remember, not one Wall Street firm or brokerage firm or bank or insurance company is a fee-only fiduciary money manager. None of them. So don't go there. Find yourself a fee-only fiduciary money manager to help you. If you're a newbie, don't start investing until you get an education. You need to have research and a strategy before you invest dime one. And I'm going to say this right now, and I've talked about this for at least 3 or 4 years. Stay out of the international markets. They are relatively weak, as my comment I made earlier. Stay in the U.S. In our estimation and what we're seeing right now, the next 3 to 5 years has much greater potential for opportunity in the U.S. equity markets than we see on the international side. The next 3 to 5 years. Remember, international, things like Europe, places like Europe, have really been cesspools of socialism for decades. Low growth or no growth. These international investments, whether stocks, bonds, ETFs, mutual funds, have had a lot more volatility than their counterpart type investments in the U.S. A lot more volatility and substantially lesser reward. So again, stay out of international investing, stay within the U.S. marketplace. I will say this, the vast majority, if not all, the new clients that my firm receives on a yearly basis that are coming from the banks, the brokerage houses, the Wall Street type firms and insurance companies have big helpings of international in their portfolio, and they're wrong. They've been wrong for decades. Look at the returns on international investing versus the U.S. marketplace. It's not a guarantee to the future, but bottom line, if a country is not growing GDP properly, if companies are not growing earnings and sales, there's a low chance, if any chance, that your money's going to go up. International, in our opinion, is garbage. Rich in Florida. I'm in the 4th year of a 7-year annuity. What can I do to get out without losing money? Rich, great question. Number one, and this is a warning to every investor, never ever be sold an annuity. Annuities in general are garbage. They're sold by advisors who are really salespeople who are working for Wall Street firms, banks, and insurance companies. You show up to the free steak dinner, that's a salesman. That person is not managing any money, and they're certainly not a fee-only fiduciary money manager, meaning they don't legally work for you. They're selling you the proverbial bag of goods. But if you're in the annuity, you've got a couple options. Most annuities allow you a 10% penalty-free withdrawal. You can do that. Or you can say, what's the cost structure annually of the annuity that you own? If you get out of that annuity and you invest in something else with a substantially lower cost structure, if the break even is only a year and a half, maybe it makes sense to take that penalty just to get rid of the expense ratio, because your break even is much better on a break even standpoint with your overall portfolio. Cost matter. The average annuity that we have reviewed at my firm has an annual cost structure of between 3.5% and 4.5% a year. That is crazy. So imagine if your money makes 7% in that annuity and your cost structure is 4.5%. What are you keeping? You're taking all the risk, but you keep only a tiny bit of the reward. So-called advisors, salespeople, love annuities because they pay lavish commissions. By the way, if you want to learn more about the disturbing facts most investors are shocked to learn, how investors get ripped off by Wall Street firms, banks, and these annuity salespeople every day, I've got a free webinar. Go to our website, ReznyWealth.com. We're going to teach you how to protect your wealth from bad advice. We're going to teach you what to do, and more importantly, what not to do with your money. If you want a game changer on how you invest, how you look at investing going forward, this webinar is for you. Go to ReznyWealth.com, click on that webinar tab. It is free, and I will guarantee you it is a game changer on education on what you should and should not be doing with your money. Robert in Punta Gorda, Florida. I contribute to a 401k plan through work and have a Roth IRA. Each is a mutual fund type. How can I protect myself from the next market crash? First off, if you're in an equity type mutual fund, if the market goes down, your investments are going down. The only way you can protect yourself is diversify properly and maybe reduce some of that volatility. Or remember, the ultimate thing is this. You have to have an investment strategy, a buy strategy, and a sell strategy. Part of that investment strategy is risk management for the next big bad recession. If you're managing your money properly and you have research, a strategy, and a sell strategy, you have a great opportunity to know when to start reducing risk in the portfolio. I will say this, most investors do not. I've got to take a quick break. I'll be right back with more questions after this. Make sure you do go to ReznyWealth.com. That's ReznyWealth.com. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Investors are getting smart. They are moving away from conflicts, bad advice, and being sold junk investments from firms that are not family fiduciaries. Smart investors demand real advice and real money management 100% of the time. If you're tired of the financial runaround, download my groundbreaking report, 3 investment risks you must avoid now. And we're back. Byron from Fort Myers Beach. For the last several years, oil and energy stocks have not had a good growth in general. I lost some large names in oil companies years ago and still keep 2 energy ETFs, IXC and VDE, thinking they will return. Would you continue to hold these for the future? No. And I've talked about oil for years. We are energy independent in this country. Oil prices are low and they're going to stay low. Oil companies in general, whether it's an ETF that owns a bunch of oil companies or whether you're buying ExxonMobil or any of the big integrateds, these companies and their ability to make money is really muted at this point. If energy stays between 40 to 60, which our firmly believes it will, these companies don't have the ability to make a lot of money. So if they don't have the ability to make a lot of money, the equity prices are probably going to languish. If you take a look at a company like ExxonMobil as an example, over the last 10 years, the stock's down about 50% in value. That's crazy. But people continue to buy oil. People buy things that are down often because they think it's an opportunity. Just because something is down in price doesn't mean it's ever going to come back. It could go down even further or just stay stagnant for decades. So again, if you have an investment strategy, if you're doing real research on that sector or that investment daily, and most people ask me, how much time should I be researching daily? Between 4 to 8 hours every single day on your portfolio holdings. If you're not doing that kind of research, then you're not really managing your money at all. And as I've always suggested, then call a real money management firm like Rezny Wealth Management that is a fee-only fiduciary money manager. By the way, we do manage larger portfolios at Rezny Wealth Management, $1 million and up. So if you are tired of the rhetoric, the bad advice from the current firm you're utilizing, and you want real advice and real money management from a firm that's got 30 years plus of experience, call our firm for a consultation. We can discuss our services and see if we can bring you into our family and help properly manage your wealth. Clark in Naples, Florida. I just started investing just out of college, and my aunt left me AT&T stock. What do you think of the stock buyback and activist investor stake, etc.? First off, I don't like AT&T stock, period. People buy AT&T stock because it's AT&T. That means nothing. AT&T as an investment's been pretty weak and lousy. If you match AT&T up against, let's say, a more broad diversified index like the S&P 500, guess what? AT&T has suffered greatly. If I owned AT&T, I would sell AT&T immediately. Look for greener pastures. You need to be invested in companies that have growth in earnings and growth in sales. If And AT&T doesn't really have any of that, or very low of that at best. Sell it and move on. Don't buy a stock just because you've heard of it, and don't keep a stock just because it's in the portfolio. Daily research and a sell strategy is vital. By the way, if you want to learn more about investing, I've got an upcoming webinar, The Disturbing Facts Most Investors Are Shocked to Learn. How investors get ripped off by Wall Street firms, banks, and annuity salespeople every day. I'm going to teach you how to protect your wealth from bad advice. If you want to learn what to do with your money, and more importantly, what not to do with your money, this is a game changer. Go to ReznyWealth.com, check out our webinar tab, and sign up. One of the things that, managing money, again, for over 30 years has taught me, investors often make a lot of mistakes. If you don't want to make those same mistakes, check out our webinar. Better yet, if you've got a larger portfolio of $1 million or greater and you're looking for professional money management from a fee-only fiduciary money management firm, call my firm during the week. We'd love to talk to you about managing your wealth professionally. I often find this: investors are busy. They often procrastinate. They wait. Or maybe it's just one of those things that you kind of forget about. At the end of the day, proper management of your assets is vitally important. Things are changing in the investment world every single day. And that's why I always try to suggest to every investor, if you are not doing at least 4 to 8 hours of pure research on your investments and your portfolio every day, you're probably not managing your money right. How have your returns been? Or if you're working with an advisor and you're realizing that advisor is really no more than a salesperson. Remember, none of the banks, none of the Wall Street or brokerage type firms or insurance companies, none of them are fee-only fiduciary money managers. Their advisors are really salespeople selling the products they're required to sell. And these are inferior products, expense-ridden products. Again, so that advisor gets his pay grade when he sells a certain allotment of that. They're required to do that. That comes directly, those conflicts come directly against what you're looking for, which is really somebody professionally managing your money. And you know what else? That advisor, him or herself, is actually not managing your money at all. It's being shoved out to somebody else. And people are kind of shocked when they hear that. Again, 30 years of experience tells me one thing. You as an investor need to get educated. We've got an upcoming webinar, The Disturbing Facts Most Investors Are Shocked to Learn. The true cause of poor investment returns and how to fix it. If you want to learn to avoid the mistakes that so many pre-retirees and retirees make every day, the mistakes that cost you dearly for financial security. Maybe you were sold a bunch of annuities. Maybe you're sold some non-traded real estate trusts. Maybe you just got this over-diversified crummy portfolio. Now is the time to get real advice. Folks, I'm just about out of time today. I want to thank all of you for all of your questions, as always. Remember, at Rezny Wealth Management, honesty, integrity, compassion, and competence. That's the difference my firm provides all of our clients. We work with investors who have $1 million of investment assets and greater. Go to ReznyWealth.com. That's ReznyWealth.com. We'll see you next week.